So my name is Don LaRoe, and this is Zephyros Farm and Garden. We've been here for 17 years, along with my wife Daphne Yanakakis, and dozens and dozens of employees over the years. We grow intensively on about 8 acres. About half of that is in cut flowers and half of that is in vegetables, all of which are certified organic. You know, I just spent a lot of time eating food out of fields when I was actually building houses. I was always building houses where people had really large gardens. I grew up with a really large garden, about a half-acre garden that my mom and our neighbor did together. So we always had fresh produce around, and shelling peas and freezing peas and making jam. And, you know, I got interested in organic agriculture. My mom died at a young age of cancer, and so eating organic food became a thing I got very interested in. There are people who work the land and they need to deal with healthy products. They don't need to be spraying nasty chemicals on the land and into the water, and just it's more about feeding the soil and creating soil that's alive. You know, it really could very well be the solution to climate change if we can actually get our soils alive again and sequestering all the carbon that we're spewing into the atmosphere. You know, we know more, practically as much, you know, about the surface of Mars as we do about how many millions and billions of creatures are in this one handful of soil. That people don't usually get into farming because they want to, you know, file a Schedule F or do payroll taxes or any of that sort of stuff, and I'm the guy that gets to do all that fun stuff on this farm. But it's really important stuff, making a budget and having a plan and seeing if the plan works out or doesn't work out, if things are, which crops are profitable and which crops are not profitable. So we're going to talk about the how and the why of keeping track of your finances, tracking your income, tracking your expenses. We're going to look at the financial statements that are common, in particular income statements, statements of cash flow, balance sheet, and we're going to talk about the basic principles of accounting. We're going to talk about the accounting equation, cash versus accrual, current versus long-term liability, expenses versus capital investments. And we'll talk also about building a bookkeeping system and what that will mean to you and your operation. So why bother? Why bother keeping track of all this financial information? That's not why you got into farming. You got into farming to grow things and plant things and take care of animals. But there are many reasons that it's important for you as the owner and person running a sustainable business that you need this information. Your financial statements will let you know if your business is profitable or not. Are you making money? You need this information in an organized fashion if you're going to ever apply for grants or bank loans. You need it to plan for each season as it comes along. You need it to budget so that you know that you don't spend more money than you have. You need this information for preparing your taxes. And finally, and probably one of the most important things is that it'll allow you to set goals and figure out if you met those goals on a financial level as well as a production level. A lot of us get into agriculture because we're interested in the sustainability that it can bring us. And part of that sustainability is running a sustainable business. And in order to do that, you have to understand basic accounting. You have to build a system that keeps track of the money coming in and the money going out of your business. And then you want to be able to use that information to see how things are going and evaluate your progress and plan for growth of your business and profitability. This is about the income statement, also called the profit and loss statement, probably the statement that most people are the most familiar with in terms of bookkeeping. It is basically a summary of the money that you bring into the business versus the money that you spend in the business. The information captured in an income statement will help you translate directly to your tax forms, the 1040 Schedule F. Typically at the top, you're going to track your revenues, so your sales by different categories, perhaps, however you want to track your sales. And there's a couple different ways to do it, but typically a lot of people will use a cost of goods sold. So that's all of the cost of production, seeds, packaging, other things that are directly related to the sale of goods. Sometimes that can also just be considered operating expenses, and there's different pluses and minuses to doing it either way, but you will see it both ways. And you also therefore have your operating expenses, direct operating expenses. Those typically go up and down depending on production, labor, delivery, rent, electricity, all of your bills, what it takes to run your office, advertising, the repairs and maintenance of vehicles, and preparing your taxes. All of these sorts of expenses show up under operating expenses. Your operating income, therefore, is your revenue minus expenses. If it's a positive number, you've made money. If it's a negative number, you've lost money. Your net income will be your operating income plus any other income minus other expenses. So sometimes you bring in money, say, from a grant, and that's not money you're going to bring in every year, and so that typically gets categorized as other income as opposed to sort of revenue. So you need to include all of those at the end of the year to see if you've made money. Statement of cash flows is a statement that is not as common, and people are not as used to seeing this, but it really helps you know how money is coming in and going out of your business. And it's an important thing to be checking in on, and it's one of the pieces of the picture that helps give you an idea of how healthy your business is. It's important to make sure you understand that a statement of cash flow is not the net income. This is not the profit and loss. This is how money comes in and how money goes out. So you have cash flows from your operations, which is going to be your sales revenue. It's going to be your outflows are the cost of goods sold, operating expenses. You also have cash flow from investments. Maybe you bring money in because you sell a piece of equipment or a piece of land or something else. Or maybe you spend money because of the same thing. You go and purchase a new tractor. So you need to sort of know this, and some of these costs are not going to be captured in a income statement, and also from financing. So maybe you get money from a loan or a grant, or maybe someone decides to invest in your operation, and then you have to pay those things back. So the statement of cash flows is an important document that is pretty easy to create from basic bookkeeping information that will give you a good sense of the money coming in and going out of your business. The balance sheet is probably the most important piece of your bookkeeping puzzle. If you go to get a loan, this is what a banker is going to want to see. And the balance sheet has a pretty simple accounting equation. It's assets equals liabilities plus owner's equity. So this is basically what you have equals what you owe plus what you're worth. And you can move this equation around. So you could have assets minus liabilities equals owner's equity, or you can have assets minus owner's equity equals liabilities. So it's an important thing to get your brain around, and it really tells you at a moment's notice you would look at this at a particular point in time. It's going to change every day as your liabilities and assets change. So it's not necessarily something you want to look at just once a year. You want to look at it a little more often than that. And so the assets are going to be things like cash, your inventory, land, equipment, buildings, if you own animals, accounts receivable. So if people owe you money, that's still part of your assets. Liabilities are going to be things like loans. If you owe money on a credit card, or you have an account at the hardware store and you haven't paid that bill, that's still money you owe to someone else. So that's your liability. And then owner equity is your ownership in the business, plus any retained earnings from previous years, other contributions you made. Maybe you invested some of your own money to buy a tractor, or if anyone else is invested in your business, any capital that they've put in, that is the equity that you own in your business. So we're going to talk about current versus long-term assets and liabilities. So you can have current things, which are basically things that you need to deal with in the short term, or you have long-term assets and liabilities that you can deal with in a longer period of time. So for example, assets that are current are very liquid. Things that you can sell very quickly and you can convert them into cash. Long-term assets are fixed assets. So think of equipment that costs more than, $1,000. Land, vehicles, that sort of thing. Liabilities, current liabilities are the bills that you owe. If you owe an electrical bill, that's a current liability. That's something you're going to have to pay in the next month. Maybe you have a short-term loan, for example. Long-term liabilities, roughly are things that are due in more than a year. So let's say you get an operating loan or a mortgage, that sort of thing. These are going to be more long-term liabilities, things that you're going to pay off over a longer period of time. Credit cards, you could argue that credit cards could be in either category. You don't have to pay them off in the short term, but often it's advised to do so. So I like to think of them more as a short-term liability, but they also can be a long-term liability. There are two main ways that you can keep track of your accounting to set up your books. There is the cash basis and there is accrual. The cash basis accounting is that you record cash when it is received or paid. So when you have revenues or expenses, you record them at that time. So you don't have accounts payable, you don't have accounts receivable, meaning you're not holding on to bills or having accounts that are out there unpaid or having people who owe you money. You get the money, so you get, let's say, a CSA share. It comes in, it's recorded when the payment is received. And expenses are paid and recorded as they go along. So if you buy some boxes to do your CSA, for your CSA shares later on in the season, you'll record those later on. Now, accrual accounting is you're going to record your revenues when they're earned, and you're going to record your expenses when they're incurred, whether or not you actually pay them at that time. So it provides a better matching of expenses with the related revenues. So if you have a tractor and it was repaired in July, but the bill was paid in August, you're going to record the expense in July. You're going to record the check payment made in August. So that expense is accrued. That's hence accrual accounting. Cash basis typically can be a single entry accounting, so you're just going to record that you got money from a CSA share. Accrual accounting is typically a double entry accounting where you're going to have match up an entity, which could be a farmer's market or it could be an actual customer, Jane Doe, to money coming in for CSA share or money coming in for wholesale tomatoes. So that you're keeping track of things on multiple levels. It's definitely something to talk with a bookkeeper who files your taxes with if you don't understand this, because it is important for them. Most bookkeepers will be able to switch from one to the other, so it's not something to freak out about if this seems overwhelming. Yeah, but it's important to sort of know how you're set up and that you need to be set up as one or the other. So you have operating expenses versus capital investments. So your operating expenses are the things that cost you money in your business. You need to buy hay for your livestock. You need to buy a screwdriver to fix a tractor. These are simple things. These are day-to-day expenses, and you'll find them on the income statement. Capital investments are also money that you're spending, but it's things that are going to be much bigger investments: equipment, land, assets. If you buy a greenhouse, it's going to cost you $10,000 to $20,000. So you are going to keep track of that in a different way, and it's going to show up on the balance sheet. Typically, these are also referred to as fixed assets, and these are the types of things that you're going to depreciate when it comes to tax time. So it's important to understand the difference between those two types of ways of spending money. So typically businesses have two types of costs. You can have fixed costs or variable costs. Fixed costs are things that don't change over time. So your mortgage bill each month or your rent is going to be the same each month. Doesn't matter if you're producing 5 pounds of tomatoes or 5,000 pounds of tomatoes. You still are going to have to pay the same insurance. A variable cost is going to be a cost that will change with production or production volume or over a period of time. So labor is the sort of classic example, or animal feed. If you have more animals or you have more production, you're going to need more labor or you're going to need more feed. So those are variable costs, and these are important to understand the difference of, particularly when it comes to budgeting. So now we get into the nitty-gritty of actually keeping the books. So this is how you keep track of all these numbers. And probably the most common thing that people use is QuickBooks. And so you have to ask yourself if you need QuickBooks. It is something that I use. I find it's integral to my business. And so I certainly recommend it, but there are lots of other options out there. The great thing about QuickBooks is that it completely keeps track of everything and allows you to quickly print out reports. So you can print out a balance sheet, you can print out an income statement, you can print out a statement of cash flows. It has all sorts of features for payroll if you're into employing people. It can integrate with online banking, credit cards. So there's a lot of things that it can do that you can add on. It is expensive. The desktop version is really quite affordable. I highly recommend getting it through an accountant because they're going to save you a lot of money, whether you do the desktop or online. They're certainly moving more and more towards online. Unfortunately, that is quite a bit more expensive. Not a step I've taken, but it seems like eventually that's going to be the way. It can be complicated. It can be overwhelming. So taking a class or working with an accountant to help you figure it out. It's sort of like paying for a veterinarian ahead of time. They teach you how to trim the hooves of your goats, and then you never have to pay them to trim the hooves again. It's that same thing. You can pay an accountant. I have an accountant. She logs into my computer. She's in a different city. She takes control of my mouse, and she teaches me how to do things. And now I can pretty much do them myself. Obviously, you can hire a bookkeeper to help you set it up as well, but it's good to know what you're doing. So there are alternatives to standalone software, so the alternatives to QuickBooks, and maybe you just have a smaller business and you don't need to invest in the larger program. So there's a lot of banks will offer a lot of stuff through their online banking. There's all sorts of low-cost bookkeeping apps, Xero, Sunrise, FreshBooks, Zoho. So look into those if you're looking for a more simple thing. And you can always set something up on your own or with an accountant, just using Excel or Office or OpenOffice or Google Sheets, these sorts of things. And there's the classic simple handwritten ledger or notebook. I think in this day and age, it's pretty important to have something on a computer. And even if you do use something like QuickBooks like we do, we have a lot of information that we keep also on spreadsheets. So it's important to be able, and I like how those two can integrate. So check out those different options before you choose one and figure out which one's going to be right for you and your business. So tax preparation, everyone's favorite tax preparation. Sort of no matter how you organize your business, you will wind up filing a Schedule F, which is profit or loss from farming. So there's sort of two parts to it. It's really pretty basic. You have your farm income, and this is where if you're doing the cash method or accrual method comes in. But basically in the first part of the Schedule F, you're going to divvy up where your income came from. So without going through it line by line, it's something that's a little easier than it seems perhaps. And then on the opposite side, you're going to have your farm expenses. And again, you just have to sort of divvy them up. And this is also a good way if you're doing a bookkeeping system that you're going to create yourself, or when you go to set up even a QuickBooks, you want to sort of have these expense and income categories broken up. It'll allow you to directly put it into the right tax box for preparing your taxes. Just to throw up some free accounting resources, bench.co has an income statement template. So if it's something that you're looking to set up yourself, you can check that one out. And sunriseapp.com is a mobile device friendly bookkeeping app that will integrate with online banking. There's numerous small farm accounting guides and resources available from land-grant universities around the country. So doing a Google search for accounting resources or setting up income statements or expense sheets, balance sheets, all these different things, you can find templates for these on the internet without too much trouble. So now we want to look at, am I making a profit? Is what I'm growing profitable? So you need to look at your production costs minus your expenses. So let's say you're growing produce, you've got the labor. You need to be paying yourself or your employees for starting the seeds, for transplanting, for weeding, amending the soil, any of the supplies that you need to pay the water bill, for irrigating, for delivering to market, labor, cost of harvesting and packaging and delivery, distribution, any of the packaging materials. All of these things are your production costs. Let's look at an example now of a microgreen growing operation. And microgreens is a type of operation that's pretty easy because it's all grown in a flat. So you can sort of look in a flat. Now, when you do this for your own operation, maybe you're going to look at pounds. You need to figure out a unit that you're going to sort of relate everything to. So think about that as we go through this example. If you're growing corn on 10,000 acres in the Midwest, you're going to look at a per bushel or a per acre valuation of whether or not you're making money. So with microgreens, you're looking at one tray or a flat. So let's say you plant 20 of them, and you're going to get 12 ounces off of each, and you've got a 16-week season. And we're assuming that you're having a 1-week harvest cycle. So when you convert that, you've got your one tray equals 12 ounces times 16 weeks. So you're getting 192 ounces or 12 pounds. So if you have 20 trays, you can see that now you're up to a yield of 3,840 ounces or 240 pounds. And it's sort of regardless of whether you use ounces or pounds, that would depend more on how you sell them. Now, these flats have a cost associated with them. So let's look at that. You've got your seed starting. You can estimate that at $25. You've got your watering and monitoring. These are all labor costs, harvesting and packaging. Then you have the cost of the seeds, and you have the actual tray, and then all the packaging that you need. So then you can look at what is that per tray. Remember, we're doing 20 trays per week. So you've got your total production cost per tray. So that's $19.50 per tray. Or you can look at it per ounce. So now we're looking at $1.62, $1.63 cost per ounce of harvested material, harvested product. It's very easy to not include all of the little things that you do, but to really have an accurate profitability calculation, you need to make sure you include all of the delivery and distribution costs. So all those times you make phone calls and take orders, and all of the packaging, and the time it takes to load the truck, and the fuel, and the time that you drive the truck. All of these things have to be accounted for. So costs, in this example, we're going to assume $25 for total distribution of the 20 trays, 12 ounces per tray. So 1 week harvest of 240 ounces. So if you have a sale price, one tray of flat is $36 times 20 trays. You got 720. Your gross profit is going to be your 720 minus your $19.50 cost per tray times 20 trays. So that's 570, and then less your distribution cost for the whole week's worth of produce. So you wind up with $305 net profit. So pricing strategies could pretty much be its own video series, but it's important to make sure that the base price includes all of your production costs. And that's why it's important to really keep track of all of these things and keep track of all of the time and energy that you put in. I think the number one problem that small farms have is that they don't wind up paying themselves. They spend all this time driving around and all this time on the phone and all this time in the field, and they're not keeping track of their time, and they're not getting paid for it, and then they don't make money. And if you're not making money, you're not going to stay in business, and so what are you doing it for? So you need to determine your base price by calculating all of your production costs. And then you do need to know what is this cost at the grocery store? What is it? What are other people at the farmers markets charging? What are other producers charging? And you need to know anything that maybe adds value to your product. Do you deliver it every day? Do you is it certified organic? Does that add a value to your customers? And really to do pricing well, you have to understand your market. And before you put a seed in the ground, you should know what that market is, because otherwise you can hope to sell something to someone for some price, but that's not really a good plan for making money. So you really need to have that sense of what you think your market can handle in terms of volume and in terms of price in order to know if these numbers are going to work out with you making money at the end of the year. So, budgeting and your yearly projections, this is something that I highly recommend trying to do from the beginning. It's easy to overlook, but it's really important to have a sustainable business. So there's a couple starting points. If you're just starting out and you don't have numbers from last year to use, then you're going to have to make estimates. You're going to have to guess. How much are you going to spend on gasoline this year? How many tanks of gas are you going to buy to go to the farmer's market if that's your plan? Or you can also use last year's numbers if this is not your first year. So then you can, it's once you've got your numbers in a bookkeeping system, it's quite easy to then translate it. We actually take our numbers out of QuickBooks and put them into a spreadsheet in order to make a budget. You want to list any changes to be made in the coming year. So if you're expanding to grow more of a crop, to go to a new market, you're going to want to make sure to capture those changes. Or if you're growing less of something, maybe you're getting rid of some animals this year. So you basically want to have your outline of revenue, expenses, any capital investments, any financing. So you have your other income and other expenses built into this as well, because you need to keep track of that stuff as well. And ideally, after the year is underway, you're going to sort of look every month and see is this happening? Is this not happening? And this is another way to keep track of the fact that, like, maybe in the spring, in March, you're going to spend a lot of money on seeds and soil and all this stuff. And are you going to have the money in the bank to pay for all that stuff? You need to be able to know that. So really having a budget, and a budget is not a dead document that you make once a year and let it sit on a shelf. It really should be something that you refer back to make sure that things are going as you expected. So I sort of have one copy that I make and then one that I will keep plugging numbers into over the course of the year to make sure things are going according to plan. As you review the budget, you can look and see, is income that you're expecting to have come in, is it increasing or is it decreasing? Are your cost of goods sold, is your sale price enough to cover, to provide a profit margin for your business? Are your operating expenses costing you a lot more than you thought, or are you able to um, save money? And do you actually have an income greater than expenses? And of course, other expenses. Are there any unforeseen or unplanned expenses creating losses? So you can sort of have categories for things like that. And it's always important to realize that there are a couple ways. People always want to make money by selling more of something, which is certainly one way to make money. The other way to make money is to sell it for a higher price. And the most important and most often overlooked way to make money is to not spend money. So to really look at your expenses and figure out, what are the expenses that I can do without? How can I cut my expenses so that you don't have to make as much money, but you still make money?